The best retirement account in America isn't your 401k. It isn't your Roth IRA, and it definitely isn't whatever Robinhood was supposed to be doing for you. It's an account most people use once a year to buy Band-Aids before forgetting it exists. And the reason nobody talks about it is because nobody makes money when you actually use it properly. Because if you've ever wondered why your boss casually mentioned this account during onboarding for about 12 seconds before moving on to dental coverage, the answer isn't that it's unimportant. The answer is that it's quietly the most overpowered account in the entire US tax code, and the IRS basically made a mistake when they invented it. It's called the Health Savings Account, the HSA. And once you understand what it actually does, you're going to be slightly furious that nobody told you sooner. Because while everyone is busy arguing about meme stocks, crypto, and whether the Fed is going to cut rates, the most powerful tax-advantaged account in the country is sitting in your benefits portal, completely ignored. To understand why the HSA is so absurd, you have to rewind to 2003. Because in 2003, the Bush administration was trying to solve a healthcare cost problem that was already getting out of control. Their pitch was simple. If we give Americans tax incentives to save for their own medical expenses, maybe they'll start shopping for healthcare like they shop for everything else. So they wrote it into the Medicare Modernization Act, slapped a tax shelter on it, and called it the Health Savings Account. The goal was to nudge consumer behavior. The accidental result was the single most powerful tax-advantaged investment vehicle in the country. Because while everyone was focused on the healthcare angle, the tax code itself was doing something nobody bothered to read closely. 3 different tax benefits stacked into one account. And nothing else in the US financial system has all 3. Not your 401k, not your Roth IRA, not your brokerage, not your savings account, nothing. So let me introduce you to Sarah. Sarah is 30 years old. She makes $70,000 a year. She works a normal job with normal benefits. And one day, during open enrollment, Sarah picks something called a high-deductible health plan, because it has cheaper premiums and her doctor visits are basically just an annual physical and the occasional flu.
And because she picked the high-deductible plan, Sarah is now eligible to contribute to an HSA. Sarah decides to max it out. In 2025, that's $4,300 for a single person. And here's where the magic starts. That $4,300 comes out of Sarah's paycheck before taxes. So if Sarah is in the 22% federal bracket, plus 7.65% in payroll taxes, plus her state's 5%, that's roughly 35% in taxes she just dodged. Which means Sarah just made $1,500 by doing nothing more than checking a box on her benefits enrollment. But that's just the first tax benefit. There are 2 more. Because once that money is inside the HSA, Sarah can invest it. Index funds, ETFs, basically whatever her HSA provider allows. And here's where it gets ridiculous. Whatever her HSA grows by, well, that growth is completely tax-free. The S&P 500 doubles in 7 years. She doesn't owe a dime in capital gains tax. Her account 10x's over 30 years. Still 0 capital gains tax. This is the same tax treatment as a Roth IRA, except a Roth IRA was funded with money that was already taxed. Sarah's HSA was funded with money that was never taxed in the first place. And then comes the third benefit. When Sarah uses the money for qualified medical expenses, she also doesn't pay taxes on the withdrawal. So her contributions go in tax-free, the growth is tax-free, and the withdrawals are tax-free. It's the only account in the entire US tax code that has all 3. Triple tax advantage. Or as financial planners call it when nobody else is listening, the HSA loophole. But here's where it actually gets stupid. Because most people use the HSA for exactly one thing. They contribute during the year, they spend it on doctor visits, prescriptions, and the occasional pair of glasses, and then they empty the account every December like it's a use-it-or-lose-it FSA.
And that's the part everyone gets wrong.
Because the HSA is not the FSA. The HSA has no use it or lose it rule. The money rolls over every year, forever. You can contribute at 25 and not touch a dollar until you're 65. Which means the HSA isn't actually a healthcare account. It's a stealth retirement account dressed up as a healthcare account. And once you realise that, the math gets pretty unreasonable. If Sarah maxes her HSA every year from 30 to 65 and invests it in a basic S&P 500 index fund at a 7% real return, she ends up with roughly $640,000, tax-free. That's not including catch-up contributions after 55. That's not including employer contributions, which a lot of employers throw in. That's just the base case. $640,000 sitting in an account where the IRS is legally not allowed to touch the growth. And here's the kicker. That $640,000 figure is the equivalent of what a maxed out 401k would generate before you start paying taxes on the withdrawals in retirement. Once you factor in the eventual income tax hit on the 401k, the HSA pulls ahead by tens of thousands of dollars on the same contribution. Same money in, completely different outcome on the way out. But wait, there's a third use case, and this is the one that breaks people's brains. Because when Sarah hits 65, the HSA pulls off one final move. After 65, you can withdraw money from your HSA for any reason you want, no medical receipt required, and you only pay ordinary income tax on the withdrawal, which is exactly how a traditional 401k works. So at 65, your HSA basically becomes a 401k, except it also kept the medical tax-free benefit. So you have a 401k that also moonlights as a healthcare account. There is no other product in finance that does this. None. The closest equivalent would be if your 401k, your HSA, and your Roth IRA had a baby, and the baby grew up to be even better than its parents. And this isn't some niche FIRE community theory either. Morningstar ran a comprehensive analysis of HSAs and concluded what the personal finance community has been quietly saying for years.
Here's how independent investor Brandon from The Mad Fientist explained it on his podcast. The HSA is the only account I know of that gives you a tax deduction going in, tax-free growth while it's invested, and tax-free withdrawals coming out for medical expenses. That triple tax benefit doesn't exist anywhere else in the tax code. So in terms of actual mathematical efficiency for saving and investing, the HSA beats every other account I know of, including the Roth IRA. And the math confirms it. $1 invested in an HSA is mathematically worth more than the same dollar invested in a 401k or a Roth IRA because of the triple tax advantage. Not by a small amount, by a meaningful amount. By the time you retire, an HSA contribution is roughly 20 to 40% more efficient than the equivalent 401k contribution, depending on your tax bracket.
So, if the math is this obvious, why is almost nobody using their HSA correctly? Well, that's where this story gets uncomfortable. Because here's the part nobody tells you. Once you understand the HSA is actually a stealth retirement account, the optimal way to use it is to never spend the money on medical bills. Sounds insane. Stay with me. Because of how the HSA is structured, you can pay for medical expenses out of pocket today, save the receipt, and reimburse yourself from your HSA decades later. There is no time limit. There is no expiration date. As long as the expense happened after you opened the HSA, you can reimburse yourself any time in the future. Which means a $300 doctor visit you paid for in 2025 can be reimbursed from your HSA in 2055. And by 2055, that $300 invested in the S&P 500 has grown to roughly $2,300.
So you spent $300, you reimbursed yourself $300 tax-free, and the IRS just let you skim $2,000 of investment growth in pure tax-free cash. This is called the receipt strategy. The personal finance community has been quietly doing this for 2 decades,
And if you have ever attended a financial planning meeting where this came up, the planner probably looked slightly uncomfortable explaining it because it almost feels like a glitch in the tax code. But it isn't a glitch. It's how the law is actually written, and the IRS has been very clear about this. As long as you have documentation of a qualifying medical expense incurred after you opened the HSA, you can pull that exact amount out tax-free at any point in the future. There is no statute of limitations. It is one of the most patient tax breaks in the entire code. So why isn't every personal finance influencer screaming about this from a rooftop? Why isn't this on CNBC? Why didn't your HR department drag you into a conference room and explain this to you on day one of your job? The answer is the same as it always is. Nobody makes money when you actually use your HSA correctly. Because HSA custodians, the banks and providers that hold your money, make most of their revenue from cash sitting in checking accounts earning 0.01% interest, while they pocket the spread. The minute you invest your HSA balance, their margins shrink, so they don't advertise the invest option. They bury it 3 menus deep on the website. They charge a small monthly fee if your balance drops too low. They make the process annoying on purpose. Meanwhile, your employer has no incentive to teach you about the long-term strategy because their job ends at the open enrollment portal.
CNBC isn't covering it because there is no ad money in "Don't touch this account for 30 years." And financial planners often skip past it because most planners are paid on assets under management, and the HSA is usually too small to move the needle for their fees. So the most powerful retirement account in the country sits quietly in your benefits portal, getting opened once a year for prescription copays, while the institutions that profit from your ignorance stay very quiet about what it can actually do. And this is the main point of the video, because the difference between using your HSA wrong and using it right is genuinely staggering. Someone who uses the HSA as intended, spending it every year on band-aids, will retire with $0 in that account. Someone who maxes it out, invests it, pays medical bills out of pocket, and saves receipts will retire with a 6-figure tax-free pot of money that can be used either for medical expenses tax-free or for literally anything else at ordinary tax rates after 65. Same person, same income, same eligibility. Completely different retirement outcomes. And the only thing that separated those two outcomes was knowing how the rules actually work.
Now, I want to be honest about who this actually works for. To contribute to an HSA, you have to be enrolled in a high-deductible health plan. And a high-deductible health plan is not the right move for everyone. If you have a chronic condition, if you have kids who are constantly at the doctor, if you take regular prescriptions, the math might not work in your favor because you'd burn through your deductible every year. But if you're relatively healthy, especially if you're in your 20s, 30s, or 40s, the high deductible plan, paired with an HSA, is genuinely one of the most overlooked financial moves in the entire system. And even if you only have access to it for a few years before life changes, those few years of contributions compound for the rest of your life. There is no take-backsies. Once the money is in the HSA, it stays there forever. And there's a reason traditional financial media doesn't cover this. It's because it's not a hot take. It's not breaking news. It doesn't trend on Twitter, and it doesn't help anybody sell you a stock pick. Nobody wants to make a video called "Open your HSA, max it out, buy an index fund, and don't touch it for 30 years, because that doesn't get clicks. Instead, you get headlines about meme stocks, AI bubbles, and whatever Nvidia did last week. The content that's loud, visible, and creates engagement. So instead, the smartest financial move available to most working Americans sits buried under a benefits portal nobody opens. And that's the lie we're being sold. That getting rich requires picking the right stock, timing the right trade, or finding the right hot tip. When the actual answer for most people is mathematical, boring, and sitting in a tab you closed last November. So if you want to actually understand how money works at a structural level, hit subscribe and turn on notifications, because I'll be covering the stuff that traditional financial media won't. Because the financial system isn't designed to make you wealthy. It's designed to extract fees from your wealth. And the easiest way to opt out of that extraction is to start using the accounts the system would rather you not understand.